Are you scared that an AI bubble is going to come and wreck your portfolio today, just like a dot-com bubble did in early 2000s, bringing the NASDAQ down by 80% and ramaging every single person who was invested at the peak of 2000? I'm here to tell you today that there is no AI bubble today, and one that is not going to happen for quite a little bit due to valuations, data, and different companies at the top of the market. Let's get right into this video to show you how you should feel safer in this market and not listen to all these fear-mongering people on Twitter or on the news. So today, most of the companies are valued on a price to earnings ratio today instead of being speculative like they were in the AI bubble, whenever only 14% of companies were profitable, and most of them were valued on a price to sales ratio, which a price to sales ratio is whenever you go and you look at your revenue and then you get your price. Today we do a price to earnings ratio, so it's price divided by earnings per share instead of that overall revenue multiple. And net income earnings per share is the bottom line, so it shows that companies are truly profitable. Today, think about your huge companies, your Metas, your Googles, your Amazons, the Mag 7. They all have huge balance sheets today, so they can survive by paying cash, and they're not taking out huge debt like all these companies were during the dot-com bubble. That was just so unsustainable. Today, they're doing $650 billion of capex, which we think that number is maybe a little bit too high, but they're building out for the future. So this is going to build out for the future, the next 20 years with this capex, which will have them having less risky debt if they even have to take any. And spending in these companies will be put back into the market instead of them buying back shares, which is even more bullish for all these other companies within the hardware sector. So something like an Iron, which you're building data centers, or hardware companies like an AMD or an NVIDIA with their chips that power all these powerful models between their CPUs and their GPUs. This will allow for the market breadth to expand and have less of the value condensed in the top 7 companies in the Mag 7, with all these other companies on the outside getting some of this money back, with these companies spending money in the market, which is going to have a trickle-down effect instead of just a buyback boosting these own companies' EPS and making them look more profitable. This is going to boost the net incomes and margins so they live up to their valuations, unlike 2000. A huge difference today is, imagine you're 2000. To get to the internet, you needed a laptop. You need to go spend $2,000 worth of today's money just to be able to access the internet. Today, think about your daily life. If you're in school, if you're in any job, you can go on ChatGPT, OpenAI, or any of these sites and say, hey, can you help me do this? And you do it in a second. So we physically use all this technology today. Another thing, like I said, there's the overall market health. The market breadth compared to today to 2000 is the market breadth is actually increasing to 65.4. So there's not as much risk in the top 7 of the market. So I mean 65.4% of the companies in the market are above their 200-day MA with the market breadth increasing. Back in 2000, it was actually decreasing. So that means only the top of the market companies were getting better and better. So this, if anything happens, it's going to be more of a soft landing effect than compared to the 2000s, where you saw an 80% crash down all the way. So that means that if companies have to reevaluate their valuations, it's going to be a lot more broad, and it's going to be a lot more softer and safer, and these companies are not valued at anything crazy. Another huge thing that we see in every single one of these huge crashes, 2000, 2008, 2022, leading up to this, we had rate hikes. So basically, in these crashes, the Federal Reserve was raising the interest rates, going up, like you can see on this graph right here. Whenever you raise interest rates, companies, the discount rate gets bigger, the borrowing costs go higher for companies, and if they have to refinance debt, it's harder to take out because it's a lot more expensive to take out that debt. And whenever you have higher interest payments, so it goes revenue to your cost of goods sold, and then you get your operating expenses to operating income, and then interest comes out of that operating income. So to the bottom line net income, that gets smaller whenever you have all these huge interest expenses. And back in 2000, they were having rate hikes and nobody paid any attention at all. So they were super, super euphoric and just kept pushing up these valuations. So we're going to get to that data later and show you what these valuations exactly were compared then to today, to show that people were just not paying attention to anything. Today, we're looking for 2, 3, maybe even 4 rate cuts, depending on the data and the new Fed chair and everything happening this year. Like you can see with our Fed funds effective rate going down and inflation going down. The interest rates going down is going to stimulate more people borrowing, which is more money in the economy, which whenever people's portfolios or something get bigger, they spend more money. And the stock market goes up, these companies' earnings are better, and it attracts international money. So it all works hand in hand. Another thing, like I keep talking about, euphoria. So the sentiment of the market was 110 then. Today, it is only 50 to 60. So people are so much more cautious today within the market and not only expecting to go up. And that's something you really, really want to see in the market. Whenever you see all the people who are usually perma bears turn to bulls, that's whenever you should be super, super scared. And vice versa. Whenever you see the market down and all the perma bulls turn to bears, that's whenever you want to buy, because that means the last bear has either gotten out of the market or the last bull has either gotten out of the market or flipped, meaning that there's only running to the opposite side of them from there. And there's huge amounts of dry powder with the money market fund is at almost 8 trillion. So like I said, there's rate cuts. Whenever you have rate cuts, that means you're earning less money on your savings in your bank account. So these people in money market funds, maybe they're getting a 4% rate right now, or yields are, I think, are around a 4%. Whenever you cut rates, that makes the yields are going to drop. The savings accounts rates that you're paying are going to drop to maybe even, they cut it a whole percent, they could drop to 3. So that you're getting one less percentage, which actually will make some people in yields or in these money market funds say, hey, I don't like the risk or whatever I have in here. Let me go into the stock market. I can get better returns for this risk versus reward. This is going to help make the market go up. The Fed's also doing quantitative easing, so they're buying back bonds. Whenever you buy back bonds, like I said, their yields go down. So your yield is your coupon payment of what you're going to get on this bond or something. So basically, you're getting less payments for holding this bond, so you're making less money overall. And whenever you buy back bonds, the price goes up and the yields go down. Price and the yields move in inverses. So that makes more people putting in the stock market to get rate returns. Another thing I want to show you today is the bullish to bearish spread, the AAII investor sentiment. So in this, you can see that the 1-year bearish high, when was that? That was the April lows. That was, like I said, you want to be against what everyone else is thinking. Whenever the bears turn to bulls, you should be worried. And in this case, whenever all the bulls turn to bears, because you see the historical average is about 38%, and this is only 31%, you see everyone is bared up. That's whenever you want to buy, because there's nobody left to push the price down. Now, right now, you can even see that it's almost tied at 38, and people are saying that there's going to be a huge down or huge up, which, if anything, this is more bullish for the market than you'd think, or it would just chop like this for the next few months, because this bearish side is a lot higher than it normally is and has been creeping up, and people are getting worried about this market. So whenever you're looking at this, maybe you do see people switch over after they've been super bullish for a while. It was a little bit dangerous, a red flag to look at, but for the most part, we'd like to see this, that more people are getting bared up, because that means there's so much more upside, and these people are going to turn back to bulls whenever good things happen, because it's human psychology. So let's look, like I said, the valuations of the market today are so much better than they were. So just a few metrics for this. The trailing 12-month PE is the stock price divided by trailing 12-month EPS. The forward PE is the stock price over the next 12 months projected EPS. And to get earnings per share is net income divided by shares outstanding in the market, or the market cap divided by net income. Your price to earnings ratio times earnings per share gives you your share price. So look at these back here today. These companies were barely growing revenue and net income. Nothing insane. Most of them were under 30%, but they were getting forward Ps of 60, 30, 100, 35. And these are so many overvalued. Like you got Cisco at 135 trillion total, and 100 forward P, only if they're going at 45, 35, which is unbelievable. Oracle's only going at 28.30 on the bottom line. 70p is unbelievable for them. Microsoft was insane, a 60xp. They're only growing 15% net income. If you look at today, all the 4Ps of every company except for Tesla is under 30. Most of them maybe even lower, close to the 20s, 25s. This is unbelievable. You're getting these companies at such a cheap discount that there is nowhere for them to go lower and drag down the rest of the market. They're undervalued by, we have them at 7.57% just off P and what they should be trading at for the market. So that means that if the top of the market is undervalued by 7.57%, for them to get to fair value, you're going to get stocks like small caps and all these other indexes run up even more with higher betas in these. So just with the top of the market being this undervalued, it's hard to shake out this market at this point, because how much lower can we go? And I'm just even going to show you this. if you look at the forward Ps at all of these times, the .com forward P was like 55 to 60. For comparison, today is only a 24.5. So people calling for this .com bubble, that P was, they were overvalued by 2.5 times more than they were compared to today. Another time, look at this October 2007, right before the great financial crisis, 28. 2024, right before this last year's tariff hit, 31. Look at this, 2021, before that 2022, rate hiking, inflation drama, 28.33. Everyone was so much more bold, and the average is 22.5. So we are a little bit elevated today, but it is valid for us to trade at a little bit of a premium for that growth within the future. So just what you should get from this graph is that 24.5p, like people are saying, oh, we're going to have a huge something happen. The market can't get down that much from here unless something insane happens, which that's not going to happen at this point right now with these, like I've been saying, these huge companies in the market that are actually real companies, valid, and they have huge balance sheets and they're built into the ground and they're harder to move than all these old companies that were just based off a price to sales ratio. Another metric to even show here is look at the PE ratio at the bottom. So say it went to 19 at the end of 2022, correct? If you got even to that, that's only a 22.4% drop from here. Nothing like that 80% people are talking about, which is a big seismic drop, but you would be ready to add. The 4P it got to last year in April was 23.34. So like I said, today it was at a 24.5 PE. So basically, to get back to this last April, it would go down less than 5% and it would be at the April lows. You're buying these companies with their earnings per shares projected for the next year, which is unbelievable, showing we're closer to the bottom than so many people think. And it's going to be really, really hard to shake this market because you would have to have something so huge happen for this really to go down, because we're already down at such low valuations based on our expected earnings in the next year, if that makes sense. So all these people are fear-mongering, and some of these things are valid, but it's almost already baked into the market where you can't get it down much lower than this with everyone bared up, like I've been saying the whole video. Now let's look at how prepared people are today. So I'm sure you've heard of all these consumer staples like Walmart, Costco, energy stocks are all up 20% this year or something. They're trading at higher forward Ps than the whole freaking NASDAQ sector almost, which is ridiculous. So it's showing that companies with people are so scared that they're willing to put their money in consumer staples and buy them up at these levels, which makes me think that has so much money to come back into these growth companies once good stuff happens. So you get AMD to report good, MU to report good, more deals with AMD in the future. That's going to start bringing up the market. These growth stocks and small caps are going to come. And maybe could it be the last final run, like I said, if we get the Ps crazy high back to 30, 40 Ps on the NASDAQ? Yes, I'd be very worried if we got that, especially with the spending next year. But the way right now you look at it, consumer staple in the .com was 14, energy was 14, materials, and over 14 4P. Nobody was in these. Everyone was in tech whenever it was trading at a 55 4P. Today, people are so much more scared. Consumer staples at a 24. Energy's almost at a 20. Materials is almost at a 22. So basically, these people are buying these safety stocks because they're so scared about the market going down. What's going to happen whenever the good reports come, the market starts going up good? These people are going to say, hey, I need to put my money back into growth stocks. I already got the sell-off. I mean, if you look at SAS and the IGV, that's down almost 30%. So basically, all that money is going to start funneling into these companies after that great Zeta earnings today, and all these ServiceNow, Salesforce, Adobe keep reporting great earnings this next quarter. And whenever Wall Street also sees the amount of revenues these huge Mag 7 companies are putting up, it's going to put them a little bit of fears to rest with that earnings. So I would expect, honestly, a huge run through the quarter two earnings. Like you saw with Meta last quarter, they got penalized for this CapEx, but this quarter it was like, hey, it's okay. So I think that's what you're going to see happen, and the market is obviously going to keep broadening out, and you're going to get values higher, and I think you're going to see SPX and NASDAQ go high, fly higher, which could it lead to the final euphoric move? Yes, we're going to be watching that because there are some warning flag, red flag signs in the market right now. But for the most part, from a valuation side, it's very hard to shake this market and get it lower, especially after last year everyone was scared and people are a lot more fear-ridden for the market. Just some things, the final verdict. Today is not like the .com bubble. There's higher valuations, higher margin companies, and there's no euphoric, insane events within equities. There's giants with huge balance sheets and cash flows. Could have bubble develop in the future? Absolutely. We could see crazy valuations where people just forget what happens because, like you said, history doesn't repeat, but it rhymes. The same stuff always happens over and over. And someone doing something stupid, and it's always what you don't think is going to happen. So something like maybe the private credit could be what brings down this market. Thank you for watching. We're going to have more videos this week coming about stocks like Zeta, updates with AMD, Celsius, all of our stocks and those moves recently. Zeta just reported earnings today, so be on the lookout for that video. We have a great in-depth analysis, and if you haven't, go check out our short for that price target. We had pre-earnings on Zeta this year, and we think we have a bunch of stocks for you guys that are going to be over doubles this year, and we're here to help you, teach you, and give you the materials and the software to help you learn to become a better investor and save time while doing this, so get you up to speed like Wall Street and let you fulfill your dreams of doing anything you want to in life because you have so much money you made from investing and being confident in your decisions, and live that life with your family, give your kids what they want, give your wife, enjoy your free time. If it's golfing at a country club, having a boat or anything, stay with us and learn with us and let us teach you and show you simplified strategies and sites that we use to get all this information to make your life better and make a difference in the future for you and your family.